Thanks everyone for joining today. My name's Brandon. I'm a certified financial planner based in downtown Vancouver, and I'll be hosting our session today with Kevin Mercier, William Maunsell, and Ryan O'Hearn. We're going to talk a lot about real estate strategy and how that fits into your broader wealth strategy alongside leverage, equities, and long-term planning. I know we've got a mix of people in the room. Some are earlier in their journey, and others are business owners and more established. So we'll be sure to provide information that's relevant to each of you that you can apply to your own personal situation. For those of you that are new to Zoom webinar, you can drop questions and comments throughout the session. We'll be recording this and circulating it to those that registered. So first up, I'm going to be running us through a bit of an economic update, talk about interest rates, inflation, and the reason why you should stay invested during volatile periods. Ryan, our residential real estate expert, is going to run through the residential real estate market, some wealth building scenarios that he's seen with some of his clients, and how you can do well in this current market, which is something we haven't seen in quite a while. We also got William Maunsell, who's an expert at commercial real estate, and so he's going to talk through some of the opportunities that are present in the market here in Greater Vancouver. And then rounding things out will be Kevin, who's our mortgage expert, who's going to talk about how he's helped many clients leverage in previous markets and how you can leverage in the current market to build wealth. You can ask questions all throughout the session, but we'll have open kind of Brady Bunch style Q&A at the end. So just feel free to chime them in as they come through. Okay, so first up, inflation. We're now back at around 2.25%. So it's close to that 2% target that the Bank of Canada is looking for. And why am I telling you this? Well, when inflation's running crazy, interest rates need to be high. If inflation is manageable, then they're not going to be able to raise rates too much. Now, we've got this Iran issue that's caused the gas prices to spike. So if that continues, we could see increased inflation, which may impact rates. But nonetheless, as of right now, other than Iran, we're in a relatively stable economic situation. This is generally a good place to be investing in the stock market, but there is going to be some short-term shocks and opportunities whenever Trump is tweeting something or if war news comes out. So I really do see these type of moments, as terrible as they are globally, as opportunities for buying into the market. Now, real estate's a bit different, and so of course, Ryan and Will talk a bit about how sort of the global market might impact local markets. But from a financial planner's perspective, that's sort of how I'm seeing things. So basically, inflation is running relatively low. Unemployment is high in Canada, which is potentially an opportunity for buying, because whenever we turn the immigration taps on, we may see the unemployment numbers start to draw down, and which means that the rents will end up going up. But it's overall, we're in a pretty, negative situation in Canada, but stable situation globally when it comes to the economic situation. So I'm going to run through just a couple scenarios from a planning perspective that might be relevant for you. Now, whether you choose to build your wealth through your business, through real estate, or through the stock market, what I'm talking about is not to say there's any one strategy that's best. It's more how do you use the various different strategies and integrate leverage effectively in order to build wealth. So it's all about where does your next dollar go? Just briefly, we've got this first home savings account that came out in 2023. If you haven't bought a home yet, this is a great program to put money in, $8,000 a year, up to $40K. Use that towards your first place. Given the mix in the room, I won't spend a ton of time on this, but you can speak to Eileen on my team if you want to look at setting one of these up. Okay, now this is where things get interesting. So when used properly, leverage can significantly accelerate wealth building. What I mean by leverage is borrowing someone else's money to buy something that you wouldn't have been able to buy in cash, or you choose to leverage for tax purposes. And the whole idea is that if you deploy capital early, you're going to tend to compound faster and more effectively over time. And this applies to whether you're investing personally or inside a corporation. And this just shows you an example of the difference between, say, saving or borrowing a large sum of capital to invest, either for, say, real estate or into equity markets, and how that can change over time. You end up with substantially more if you've been leveraging. Now, this is an example of how this actually plays out. So I had a client that bought a home in 2019. They borrowed $100,000 to invest into equities in 2020 when the market was down. They ended up selling that investment a few years later when they were on maternity leave. So they got interest that was tax deductible for that period of time when their income was high, and then they sold the investment when their income was low. And because capital gains you don't pay until you sell, they were able to have a lower marginal tax rate when they sold. So this was kind of a perfect scenario, but it really goes to show you that it's about sequencing, and sequencing matters. If you're about to buy your principal residence or you're about to buy a business property, you don't want to be leveraging into equities because equities can be pretty volatile. But if you just got your home and you know you're a few years away before you're buying that next one, this could help you accelerate the amount of capital you'll have for that next purchase. So this particular client, because they sold their leverage investment, they ended up having more capital to buy a detached property from the money they'd saved up, plus that leverage investment. So it really helped accelerate their net worth and put them in a great position for purchasing that next property. And for business owners, the same concept applies. It just shows up in different decisions, like whether you're going to structure a separate corporation for holding your real estate and perhaps rent that to your operating company. But ultimately, it's about sequencing, it's about understanding structures and making sure that all of your professional advisors are on the same page with what your long-term goals are. So just want to briefly put this perspective out there because I know we do have a few business owners in the room. Real estate isn't just an investment decision in that case. It really is a strategic one. So, we'll talk more about this, but whether you choose to lease your property or own your space, how you want to structure it and hold the property, whether it's through a separate corporation or through your operating company, this can have a big impact over time. And so this is something that I thought a lot about when we bought our space here, and Will did a fantastic job of helping us find the space within the Terminal City Club building. And it's already starting to pay dividends in terms of owning the space and having that flexibility long term. So something very important to think about, and that's why having the right professional advisors on your team can really help you in these big decisions. Now, these are sort of simple rules of thumb, but make sure you're working with advisors you trust, especially when the decisions involve multiple things, moving parts, such as tax, legal, and finance. You don't want to have your advisors sort of working in silos and then you have to kind of coordinate them. Ideally, they can coordinate together and work on your behalf. Second thing, regardless of how big an opportunity might seem, make sure you continue to maintain emergency savings, whether that's corporately or whether that's personally. You don't want to be caught in a situation where your regular income stops and you can no longer pay for these things that you've borrowed money to purchase because the banks will take your stuff. And then the last thing is be consistent. So time in the market beats timing the market. Don't just try to flip properties or flip into equities and flip out. You should be thinking long term with all the decisions that you're making because we can't control what the Bank of Canada is going to do. We can't control what Donald Trump's going to do. We can't control what Mark Carney's going to do. We can only control what we do and making the best decisions we can with what data we have in front of us. Okay, so that's sort of a brief snapshot of sort of where things are at economically and how I'm thinking about things as a financial planner. Now I'm going to bring on Mr. Ryan O'Hearn. So Ryan, I've known since our time in business school. He's a detail-oriented yet highly personable real estate professional. He's helped many of our clients find their homes and investment properties. So whether you're purchasing your first property or your fourth, having a conversation with Ryan will make sure you're better informed and more confident in your decision making. Over to you, Ryan.
Thanks, Brandon. Appreciate that intro there. So a bit about myself, as Brandon mentioned, my name is Ryan. I work with my brother Daniel here on a team. We work with Rennie Associates Realty, been licensed since 2018, and we have a focus here on upsizers, so families looking for more space, new home purchasers, so first-time buyers, as well as the pre-sale new construction market. That's kind of been our bread and butter for the last 7 years. See if the slide move works. There we go. Nice. So what was the main reason for buying a home in 2025? Survey says 35% was upsizing. Reason number two, first-time buyers, and change of location downsizing came third and fourth. You'll notice investors are largely absent on the survey here. We can personally attest to this. Last year, we had maybe one investor client, two investor clients, but when you're looking at buying your home, this is also investment. You're building equity and you're doing something long-term. So, and we've also experienced mostly upsizers and first-time buyers being uh, the main person that really wants to make a move in this market, and it is paying dividends for them. So let's look at the trends here from the last two corrections to get a bit of context of where we're at currently, and this could shed some light on what we could see going forward. So the 2008 correction, the Greater Vancouver real estate market experienced a 13% price drop. So from peak to trough was 13%. The 2018 correction was about an 11% drop. Now, the most recent correction at 2022, we're seeing about a 10 to 12% drop. Depending on which market we're looking at, this has like been very broad based. If you're looking at Fraser Valley, you're seeing more like 20%. In Vancouver, 5 to 10% is quite common. This is compared to the May 2022 peak pricing. So this next chart here shows different potential trajectories of where we could be going. And it shows basically a bit of context of what it compared to May 2022, the peak pricing, how long it's going to take us to recover. So if we look at the black line, it took 21 months in 2008 to go to the bottom of the market and recover back up. The 2017, 2018 correction was just over 3 years, so 35 months. That's the gray line. This correction has been the most interesting one because as of next year, May, it's been 4 years. We're basically at 48 months. The slide's a bit old, needs to be updated, but 48 months of a correction here. This is by far the longest correction we've seen in the last 25 years, maybe longer. And but it doesn't tell the entire story. So if you look at the red line specifically for the 22 correction, you notice a couple bumps. Basically, I call them camel peaks here. We actually had two mini bull runs during this most recent correction. The first one being in early 2023 when prices ran up about 7%, and early 2024 when prices ran up again about another 3 to 5%. The reason for this, you might be wondering, is when interest rates are high, the irony is that nobody wanted to list their home. We weren't getting many phone calls to list at the time because everybody thought it was a horrible time to list. So inventory was very low. And what happened in January 23 and January 24 is buyers got very excited. It looked like inflation was under control, interest rates would be coming down. So they want to jump into the market to beat the crowd. And they ended up fighting over the very few properties that were listed. And I say, yeah, the sellers that actually went against the herd and listed at that point did quite well since there was not a lot of competition on the selling side. And they did very good attracting all these buyers. We were hoping for that last spring and basically 2025 to happen again, but this is where the trend broke. What happened this most recent spring is the sellers all decided, hey, this is the best time to list because interest rates are not going to come down much further. And this is the time to go. And because all the sellers piled in at the same time to put their property on the market, there was a lot more inventory. And then you throw in on top of that geopolitical tensions, tariff talks, an election of our own in Canada. The buyers actually pulled back at the same time as the sellers went forward. So with high inventory, low demand, we experienced quite a big price drop in 2025. Going forward, we do see the further downward pressure on pricing. Inventory levels for this current spring market are still very high, but a glimmer of hope is that it's not getting worse. So at least it's very high. It's kind of peaking out, and we're hoping at this point the buyers will start returning and we'll start kind of eating at the inventory, and we'll kind of have a bit more of a balanced market. But currently, it's definitely still a buyer's market right now in all three: townhouse, condo, and home. All three asset types are seeing a buyer's market. Opportunities. So what are we seeing for opportunities? First-time buyers, this is your time to shine right now. As you may have heard, the GST rebate was finally announced after I think like 10 months. Leave it to government to take forever to finally approve something, but it is here now officially, so that's great. So homes under $1 million, you can have basically that 5% savings. And also the transfer tax exemption. This applies to any principal residence for new construction. And this is great because as a first-time buyer, if you really want to optimize this, you can stack both these programs. If you're buying a brand new home, say for $1 million, you're saving that $50,000 on that GST rebate. And furthermore, you're saving another $20K on that 2% transfer tax rebate. So that $70,000 savings is definitely something to consider with more cash in your pocket end of the day. As Brandon mentioned as well, first-time homebuyer savings account, that's a no-brainer. Open it up. You don't even need to fill it up with money. Just open it and build that contribution room. And Brandon can help you on how to invest that. And while investing that into the market, You're growing that down payment, and when the time is right, you can put that down payment to work in your property. The RSP home buyer plan, I won't spend too much time on that, but essentially it's a loan to yourself for 60K. Again, Brandon can talk to that a bit more on a phone call. Cons of buying right now, you want to be extra careful as a first time buyer of purchasing older properties because appreciation is not a no-brainer. Think of before you buy anything that goes up, we might have a flat market or, a bit of a downward market or just a sideways market for a while. So in an event where the condo needs a brand new roof and everyone needs to pitch in 20K, that's going to really hurt in this market when you want to build equity. It's the whole point of this webinar is building equity. So making sure you have a realtor where that's where our job is to go through depreciation reports, engineers reports, make sure you're buying into a top-notch strata with savings is like times 10 even more important right now. The other con of buying, and it's not really a con, but an opportunity cost is you look at rental rates. Not as a realtor, I never want to recommend renting, but this is probably one of those few windows where I could see the argument near term for the next year to 2 years. I don't have time to get into detail, but we have a lot of rental supply in the market, and paired with lower immigration, rental rates are probably coming down the next year or two. But if your goal is long term, you're thinking like 3 to 5 years, I'd say maybe 5 years more so, and you're ready for that to plant roots, it's still a great market to buy and you're building that equity for the long term. So that's kind of our question is, am I ready to plant roots for the long term? That's the question to ask your first time buyer self. At the minimum, open your FHSA. Upsizers. So this is another big opportunity here. And the reason why you think about a $700,000 condo, which is kind of the typical case here. We have a 700K condo. We want to trade up to a $1.5 million duplex, right? So that 10% hit on the condo it's a 70K hit. I know it's still a good chunk of change, but 70K hit on the condo that you're selling, but you're buying something that's gone down 150K because that 10% is hitting the duplex as well. So by going against the grain and trading up in this market, you're in a more of a net positive position. And right now too, you can shop. Like it's a fun time to be a buyer. We had a duplex that we were looking at, and they had black toilets for some reason. Don't ask me why you put black toilets in a home. It's not a typical thing that you'd see. The buyer said, "Hey, I love the home, but I don't love the toilets. Could Mr. Developer, can you change the toilets and change the tile to something more normal?" And developer said, "You know what? Yeah, we want to get a deal done. Send us an offer. We'll make it happen." So this is the time where you can have that wish list and ask for a lot more than normal. Con of upsizing right now, of course, if you don't need extra space for the next 3, 4 years, maybe don't do this just for the sake of it. But if you're planning to have a family for the next year or two, or that's in the works, yeah, maybe you want to think about upsizing sooner than later and trading up against the market. Honorable mention here for downsizers. You look at the luxury condo market, it's been really, really hammered really hard. So if you're able to sell your detached property for $2 million, lock in that tax-free gain while it still exists. Not to be a conspiracy theorist, but you never know if this thing could change, right? With the government, so with so much debt, you got like all this property equity, that could change one day. So lock in that tax-free gain now, and you trade into a luxury condo, something you don't have to take care of a yard and nice and easy. And something to watch from this one, which will be very important for downsizers, is if this GST rebate will extend not only first-time buyers, but if they open it up to the larger market. We've already seen that in Ontario occur, where new construction homes are GST and HST waived completely for everybody. So if this comes to BC, this will move the downsizer rating from a neutral rating to a hard buy rating, because now you're saving, not only getting your tax-free gain, but you're saving on the GST for your condo. So something to watch for downsizers. Don't need to do it tomorrow, but I would definitely pay attention. Final opportunity here. We look at two homes, 1755. That's the half duplex on the top, and then we have an $850,000 home on the bottom. Very similar, same 5 minutes apart, 1,800 square feet. And you see the $1 million difference. I'll ask the rhetorical question in the sake of time. Why is it different? You might be wondering, $1 million is a big deal. What's going on here? So here's the solution, and this is a trend which will continue. I call it the mom and dad, can we build a home in your backyard solution? So in Burnaby and Vancouver, they've opened up the laneway guidelines. You can essentially build a 2,000 square foot laneway house in your backyard if the lot permits. And this is a client example here in South Burnaby, where the daughter, who is looking for a townhouse had to basically shell out almost $1.7 million to buy something that was good for her family. And they didn't have the cash for that. So what they did is they went to mom and dad and they actually qualified for a mortgage for $850,000 to just fund the construction of the home. So the advantage of this is that the children, adult children, are saving $1 million of land costs. They're just paying basically for the improvements on the property. And that $1 million saved is $4,600 a month in mortgage saved as well, which you can invest elsewhere in the market. So when you think of it from this perspective, they're saving $1 million. And also, not to mention, my favorite is free childcare next door as well. And as having a child just recently myself, I know this is invaluable, probably worth more than $1 million, and definitely something to consider if you're in this looking around the market as well. And we can put you in touch with builders. That's the most important thing. I'll pass it off to the next, oh, wrong way, next speaker here, and Will take it away.
Thank you for the introduction, Ryan, and a great presentation by both you and Brandon. Lots of insights there. So I will be covering commercial real estate specifically, healthcare and investment commercial real estate properties. I do specialize in this area. I've been a commercial real estate broker for 10 years, and I'll get into what we are seeing in the market in terms of statistics, opportunities, and some recent deal successes that we've done recently as well. So overview, I'll give just a brief overview of Luck Real Estate Group, my business partner Calvin Luck and I's company, myself, market stats, opportunities, what works and what doesn't, because in the commercial real estate space, it is very different than residential. A lot of listings do not hit the public market, so it is really important to have a knowledgeable, trustworthy, and hardworking advisor, and then some recent success stories and how to find some great deals. So who we are, Luck Real Estate Group. We're a commercial real estate brokerage team with 5 brokers, 7 total staff. And so we've leased over 500,000 square feet combined, nearly 2 billion in commercial real estate transactions, and over 200 plus successful transactions across the Lower Mainland. Myself, as I mentioned, been a commercial real estate broker for a decade. I specialize in medical, dental, healthcare related practice advisory, both in leasing and sales for their properties, as well as mid-market investments and private equity. So market stats and trends. This is some overarching statistics by asset class. So as you can see on the left-hand side there, there's industrial, office, retail, and multifamily. Largely the trend that we have seen, especially with multifamily, which as Ryan alluded to, there are some great rental opportunities in the market. So there's been a flood of multifamily construction due to CMHC financing. So largely what we've seen is multifamily transactions have cratered quite significantly as yields have really taken a huge uptick as they are in inverse correlation to interest rates. But the hard part about the transactions in multifamily is there's a lot of owners that are not willing to sell at the price that the market is willing to bear in today's market. Many owners are stuck on yesterday's pricing, which is largely based on land. One item I did leave off of this chart is land. Land values overall are down about 40 to 60% from the peak. A larger transaction that I want to highlight, a developer named Celtic Developments, which is in the news about the Brighouse site that is in Richmond, where the Olympic Oval is. They purchased that site for around 300 million quite a few years ago, and now that site is being foreclosed on, and the valuation is likely in the range of the mid 100 millions. So that is a huge adjustment on where they purchased that property. So largely what we're seeing in today's market is transactions are driven by income or by owner users. So on the income basis, we're seeing savvy investors either refinancing their portfolios and deploying that capital at pricing that makes sense on an income or building basis. Land values in many respects are actually less than what the building is worth itself. And then on the other side of things, the necessity of a building for a business is driving a lot of the transactions that we're seeing. So in summary, Most transaction volumes in asset classes have been declining year over year, except we are seeing an uptick in office because office did bottom out towards 2024, and retail has been really the darling asset class. So that includes strip malls and freestanding buildings. Opportunities. So based on what we're seeing in the market where there are motivated sellers, where pricing is much more attractive, where there has been a reduction in price that we haven't seen in decades, we believe the best opportunities right now are include some of the following and maybe some others as well. Well-located freestanding office and industrial buildings. Um, Office has taken from a valuation standpoint, they've taken a really hard hit, especially due to the work from home culture. But we are seeing a lot of people go back to office with many mandates, even in government. We're seeing a lot of people going back 5 days a week. So well-located, amenity-rich office space that is transacted recently includes the Canada Post building, which Ponte Gadea, Matzio Ortega, the owner of Zara, purchased for 1.5 billion. So large transactions like that, obviously, they don't happen very often, but when there is smart capital making decisions like that to acquire an asset like that, typically there is a trend to follow. Industrial buildings, likewise, we have seen rents compress fairly significantly there due to a lot of supply that's come on the strata market. But that being said, industrial land, we are very scarcely supplied with industrial land due to the constraints within the Metro Vancouver region, including mountains to the north, water to the west, a border to the south, and the agricultural land reserve, which creates an artificial constraint on industrial land. And until the moratoriums hit, industrial land was in many cases being redeveloped as residential condos. So many municipalities are not allowing for that anymore to preserve those industrial lands. And then on the retail side of things, mixed use buildings that includes office with retail and multifamily with retail have great opportunities for both investors and owner users. Strip malls, industrial strata below market pricing, especially on a price per foot basis on those. We are seeing some older stratas that are trading at very competitive pricing and motivated owner users. So we are seeing a lot of baby boomers that have owned businesses and their properties for a long time. They're actually looking to either sell their business with their property or just sell the property to pull some of their equity out and look to invest it with someone like Brandon. And so we are seeing those retirees look to sell their property and lease back or sell the property and sell the business together. And then lastly, I'll touch on portfolio sales. Again, that's another retiree function where we are seeing a bit of a passing of the torch. Many private equity investors that own a lot of assets, maybe their children don't want to take over and manage the portfolio. And so they are looking to dispose of some of those assets and capitalize on the longer term appreciation that they did observe. So commercial real estate, what works? It is a very different industry than residential because a lot of listings don't hit the public market. Many are exclusive and or off market. So it's really important to have a trusted commercial real estate broker early on, someone that can provide market information, market intel, and introduce to the necessary bankers, mortgage brokers like Kevin, and the people that are going to be able to help you acquire property. Examining company practitioner existing CRE obligations. So this is a really important function of figuring out what you are approved for in terms of being able to acquire additional property. What is your existing debt load? Someone like Kevin can really help and assess that for you, and he'll dive into that a little bit further. Building a strong team of advisors. Again, this includes your commercial real estate broker, but also an appraiser, a contractor, especially if you are a practitioner or a business owner that is looking to build out a space for your own business. Having all of these practitioners at your at your side and looking out for your best interest is really important. It makes the deal process much smoother. It allows you to make really educated decisions, especially when it comes to a building for your own business and its suitability and some of the risks that might be involved. And lastly, financial organization and long-term wealth planning. Someone like Brandon that's able to help you long-term plan for a larger purchase, like a commercial real estate asset, or even if you're co-investing with family members or other investors to buy a building or a strata commercial property together. So making sure that you cover all of those bases and can plan in far in advance is really important. So what doesn't work? Last minute decision making in commercial real estate, the deal timelines are a lot longer. You see longer due diligence periods. You also see longer closings. Typically, it's going to be really difficult to make a last minute decision on purchasing a property that there are a lot of intricacies that you will need to uncover. So it is important that you know all of the factors that go into making that decision, whether it's an investment decision or a business decision as an owner occupier. Not working exclusively with a commercial real estate broker. This doesn't work, I believe, on the residential and commercial side for many reasons. If you are loyal to one broker for the purposes of what you're hoping to achieve, that broker will be loyal to you as well. They're going to be feeding you a lot of market information. They're going to be putting all their resources to work for you. They're going to be allocating a lot of time and effort to ensuring that you can make the best decision for yourself. If you're working with multiple brokers, none of those brokers are really going to be loyal to you, unfortunately. And to be honest, you're probably not going to be the first call that they make if they get a very exclusive listing that is quite attractive. So important to have some loyalty. Lack of clear requirements. So if you don't have clear direction on what you're looking for from an investment standpoint or even a business standpoint, it's going to make it very difficult to uncover an appropriate asset that you're going to be excited about and can acquire that hits your requirements. So having a clear understanding of what those requirements are, what are must-haves, what are nice-to-haves within the price range that you have budgeted. And no transparency or feedback. So this kind of ties into the requirements piece. Obviously, when putting surveys of property opportunities together, having that feedback makes it much more effective and valuable to be able to find a suitable property. Also, transparency. If you'd seen a property before, and you can be transparent about that, that makes it really helpful to find more suitable opportunities. So now we're going to dive into some recent success stories from our team. We've had a very active first quarter and a very active Q4 of 2025. So primarily I'm going to be covering transactions from those two quarters. So this asset here, this was a partial investment and owner-user purchaser. So it's a mixed-use building, fully stratified, owned by one owner. This is what we call a non-conforming strata. So this strata does not have a strata corporation. They don't have a contingency reserve. Effectively, this owner operated this asset like a mixed-use rental building, but they just own all of the strata lots individually. Why this is a really unique asset is there are multiple exit strategies. The owner bought all 18 strata lots, so 14 residential, 4 retail, with a building size of just over 17,000 square feet and land size of just under 12,000 square feet. And this allows the purchaser, as the owner user, to either sell off some of the units, they could renovate some of the units, re-rent them out, and increase the rents. And on the long-term basis, there is redevelopment potential under C2 zoning for a rental building. So one can actually build up to 3.7 FSR, which is the density, times the lot size, if you assemble to the corner. This was a clinic relocation and expansion success story. So a client of ours that is a general dentist had a current clinic on Main Street, and they were currently leasing within a building and unfortunately had a demolition clause in their lease. This is a very common occurrence that we see with many of our practitioner clients. If you do have a demolition clause in your lease, it's very important to seek professional advice especially from a broker that can assess that demolition clause because they're not all written the same. But a demolition clause can affect the value of your practice and affect your retirement planning as well. So it is really important to have that in mind. Leasing is a good option in many cases, but purchasing is also a good option in many cases. And I can handle, um, some of the questions in that during the Q&A period. So it really depends on your scenario, your long-term plans, and capital restraints as well. So this property, our client ended up getting this for an excellent price at only 4 million for a 3,400 square foot building, a block and a half from the Mount Pleasant SkyTrain station on just under 5,000 square feet of land. A really rare part about this deal was 4 surface parking stalls at the back, which, as many of us probably know in the Mount Pleasant area, is not common. So this is a great success story for our client that will be building out an expanded general dental clinic. So this is a unique one where, in contrast, by the last property, our client purchased this one as a owner user on the ground floor only, and they're leasing out the upstairs to a general office use or a complementary use to their clinic. So, oh, the slide just changed on me.
Sorry, that's me. Just a heads up, Will. We're just running a bit ahead of or behind schedule.
Okay, yeah, I'll speed it up.
Take her back.
Okay, there we go. So yeah, this is a unique one because our client is an owner user, but they are also going to be a landlord in this. So he acquired the building for 4.45 with underground parking as well. The second floor office space is currently available for lease. So if anyone does have a business that might want to be above a very high-end dermatology clinic for some good referrals, please reach out to me later. Another investment asset here, longer term land upside as well. So it's in the Burrard Area G plan of the West End Community Plan. Up to 11.16 FSR is a rezoning precedent, so a high-rise rental building around the corner, but significant holding income on this property, and very close to the beach as well. And this one is a strata office success story that another general dental client of ours is relocating within the downtown core. And this one I really want to highlight because oftentimes many people think that commercial property is way out of their price range. To be honest, we are seeing prices even on freestanding buildings that are very attractive. This is a case in an office strata. We were able to negotiate for 2 EV stalls at no cost and additional storage, and a bunch of other inducements for our clients. So it's also a rare office unit that has a patio as well. So lastly, how to find great deals, off-market deals. Many off-market deals are built through great broker relationships. What I mean by off-market deals are deals that are not listed on the market, but the owners have directed us that they're open to selling and open to looking at offers. So many times these deals will never hit the market, but having a great broker relationship will have you first on the call list and exposure to these kinds of deals. And that's it for me, and I'll pass it off to Kevin.
Awesome. Thanks, Will. Appreciate it. Good presentation. I'm really excited to have Will on board this year for our presentation, primarily because it's an asset group that we haven't really explored previously in this session. On the commercial side of things, how lenders look at it, it's more of a like debt coverage ratio instead of looking at the covenant specifically. So they're not looking at you as an individual; they're looking at how the property covers the debt load. So it's kind of a different market on that front. So as you're growing your real estate wealth, it's a very good opportunity to take advantage of. If you could go to the next slide, Brandon. Next slide. Won't bother with that. Just a little bit about myself. I've been almost 20 years in this industry. I've seen a lot. When I got in 2007, 2008 happened, so that was fun. Being new to the industry and seeing that crash happen, but we recovered from it really quickly. Ryan had some great insight about kind of the market lull In my time in this industry, in those 20 years, this is probably the longest lull that I've seen, which to this market and what we're presenting right now is an extremely good opportunity for you to buy. And how I'm going to showcase that in my presentation is leveraging the equity that you currently have in your home and using that equity to actually make you money instead of just sitting in your house doing nothing for you. So that's just kind of a little bit of me. So what I'm working with clients is just building their portfolio. I just had a client that so it didn't sell, sorry, was based in Port Moody, and they wanted to buy into a townhouse, right? So, how I built my real estate wealth back in the day was like I lived in the place, and then I took out equity, and then I moved to the next place. So that's exactly what I'm kind of training my clients to do in the same capacity, where their old property they turn into a rental, and the new property is their new home, right? And you can do that multiple times. So um, that's what I'll kind of showcase in this presentation. A lot of this stuff that you see on the screen right now, Brennan, alluded to earlier. Unemployment was high. I think we lost what 82,000 jobs in February. What we're seeing now is a stagflation situation, where you're starting to see potentially inflation going up because of gas prices. And when you think about gas prices and oil cost, that spills over everything, right? From, the products that we buy, all that transportation, everything that happens, that's increasing, right? So, but in saying that, the stagflation part is that the economy is in the drums. Nobody's doing well. Nobody's spending money because everybody's consumer confidence is down, and we're seeing jobs lost, which would dictate a lower in interest rate. So the perception now is that the Bank of Canada is going to be staying stable throughout the year. That's what I project. That's what most economists are projecting. That's what my gut feeling's telling me, because I don't think they're going to do anything too extreme high, too extreme low. They're just going to balance it out, wait till the war ends, and kind of go from there. So vacancy rate in Vancouver, it is up a little bit. So I think we were 2.5 last year, 3.7 right now on your rental properties. Growth over 5 years, over a 5-year term, it's still 26% higher on your property, even though we have come down. Year over year growth, we're about down 5.7 in the Lower Mainland area. From what we're looking at there. So when it comes to investing, you're kind of putting yourself, I need to become a landlord now. A lot of clients that I work with, so I say sometimes, like, if you bought a detached home, maybe try and find a detached home with a basement suite, and that could be it. But it's not that hard to be a landlord. I always say buy properties that are close to you. If you're handy, it's easier too, so you don't have to hire anybody to like fix the dishwasher or fix the carburetor. But I can coach you in that process because I've been there. And one of the biggest keys of being a landlord is pulling credit, right? You want to make sure that the person that is renting your property pays their bills off in time and it's a priority for them. Take an application. There's some great services out there. One I highlight in here is called Pendo. So Pendo like allows you to kind of take an application, store it there, and manage all your applications that you take in for your property. And lastly, there's you could hire a property manager. I have a list of property managers too. It's just taking off your obviously your profit, because you're paying them 5 to 12% of the rent each month. So. All right, so the power of your equity. So this is what I pride myself on, and what I love to see with my clients is that in most cases, I would say on average would be about a 4% increase per year. In Vancouver, the last 10 years, it's been a lot higher than that. So what I'm seeing right now is a bunch of people that are sitting on the fence because of consumer confidence. And my theory is that all these people sitting on the side of the fence, it's a great opportunity as investors to get some really good discounts on properties as an investor, as a rental property, because you're going to buy it low, right? So you're going to buy it low in this zone, and then you're going to have, once it does boom again, and it will in Vancouver, it will. I promise you that. And it all is about consumer confidence. And once first last year was tariffs, right? This year, the war, right? So that's had an effect on consumer confidence. And I've done sales this year. It was better than last year, but most of my business right now is refinance and renewal. But I have done, purchase sales. But what we're seeing right now is just a lack of consumer confidence, and everybody sitting on the sidelines. So when that consumer confidence is back, you're going to see boatloads of people jumping in the pool at the same time. And what happens when boatload of people jump in the pool at the same time? It overflows. And we get into situations where we were in the previous years back in the day where, you're going in with subject free, offers, which isn't ideal either, right? So what I'm saying as an investor, now is a very good opportunity to look at the equity of in your home and seeing if that equity has better use than just sitting there doing nothing for you, right? So the scope that I give you here, 1 year you bought your house, the value of that house was 950,000. Year 5 worth 1.15. You're paying down your mortgage at the same time. Year 10 worth 1.47. You're paying down your mortgage throughout that time. In that 5 year, 10 year scenario, like you can pull out 250 grand in that 5 year scenario, and you can pull out 568 grand towards a new home in that 10 year scenario. So next slide, Brandon. So what you'll see here, and I apologize because the chart just kind of got wayward, but it's transferred over. But in this scenario, in the 5 year scenario, you're taking a $215,000 down payment and purchasing something that's now 1.075. And your mortgage on that would be 860. Your monthly mortgage payment about 4180 in today's rates. And then your rent to that point for a property about that size could be about $4,000 to $5,000, depending on what type of property it is. But what you're looking to do is cash flow on that property, right? So we always extend out the amortization as far as possible with rental properties. One, because you want to write off as much interest as possible on that so that you're not getting dinged on taxes. And two, you have a net effect where the mortgage payment on your new home, if you go that route, or it's still your old home, is netted down. So like when I did this back in the day and I upgraded, I got to a point in my life where I had no mortgage payment whatsoever because of my cash flow ability. So, that would be the ultimate dream for anybody, obviously, to have your mortgage payment serviced by your rental. So, that's what I showcase here with people is just like, really what you're doing is you're leveraging money in your house to work for you, and build your net worth, right? So, your home one, so say that you didn't do anything, your home one in 10 years would be like $1 million in equity. You almost double that if you invest and you leverage the equity that was currently in your house at year 5, right? So, and you're leveraging, say, the 250 grand it was to put it as a down payment, you take it out of your current home, but you're going into an asset class where you're earning the percentage on the value of the house, not the value of the 250 grand, right? So, in this case scenario, like, what would you rather have, a net worth of 1 million or a net worth of almost 2 million, right? So it's just such a great strategy to leverage the money that you have and you're earning through equity. So just a little recap: investing in real estate is a tremendous benefit. I would say even now, like it's an opportunity, right? So, in markets where people are shy is when you want to invest because you're going to get the best deals. Being landlord isn't as tough if done right, and you have a coach like myself to help you through that. Um, and investment property can lower your mortgage payments, obviously, if you cash flow properly on them. And at the end of the day, as families and what you want to pass off to your children, it's about building net worth so that you can pass off all that equity when you die back, in the future, off to your children and to your next of kin. So that is it for me. Hopefully, I caught us up.
Beautiful. No, appreciate that, Kevin. So we're going to move over to Q&A. So if you do have questions, feel free to drop those in the comments. The goal today is really just to have shared knowledge among multiple professionals because we all come with slightly different lenses when it comes to real estate, when it comes to the stock market, debt. And that's why you should have a team supporting you when you make these decisions because they are big decisions. Your real estate professional will have an opinion, your mortgage person will have an opinion, your financial advisor will have an opinion, and then you'll be able to make the best decision given the feedback you've received from all those advisors that you trust. Okay, so pulling up the questions here. First one we have is coming in from Mark. Have the recent court decisions around Indigenous land claims impacted the feasibility of real estate or investing? How much of what's been discussed is overblown versus what's actually going to impact people with regards to fee simple ownership models being threatened by these decisions? Who wants to take that one?
I can touch on it.
Thanks, Will.
So I know there's obviously a lot of concern around this issue from many people. I've been proactively consulting a lot of the lawyers that we work with, especially ones that specialize on the Indigenous side of things. From what I've heard from our lawyer contacts is one, a lot of the fear in the news is a little bit overblown in terms of your property actually being at risk and you not being the rightful owner of that property. So in the longer term, this will be resolved and there will be consumer confidence back in the market. But on the flip side of things, a lot of this fear mongering and a lot of what's happened in the news has caused waves within the international communities and their confidence in Canada and their confidence in bringing capital to Canada. So from a smaller standpoint, say if you're purchasing a home or if you're looking for a residential property, I don't believe you're going to have any risk there. From a larger standpoint, in terms of our municipality, our country, and attracting international investment for infrastructure, and to build roadways and transit and bringing large companies here, we do have challenges with that because our government is seen as unstable by the global markets. So we do have some work to repair that.
I can do a quick note here on the residential side. For us, like it hasn't had a massive impact. I would say, like just to echo Will, it's just been more of a confidence perspective. I think people are just asking a lot of questions, and it's just one of those things where we don't need more reasons to be afraid of the market. And this is the government has kind of just given us another one. But yeah, like we know eventually this will be resolved. And I just agree with everything Will said. It will be resolved. And it's just a matter of time until they can't play both sides. The government and eventually does need to come to like a decision, and they can't play. They've been kind of playing both cards. So at some point we will have a resolution. Just that's yeah. Unfortunately for those owners in the immediate area in Richmond, I think it's a bit more of a impact. But just in general, when I'm dealing with homeowners buying in Vancouver and elsewhere, it hasn't really been a reason to not buy.
Thanks, gents. Yeah, it's a tough situation, right? You've got different competing interests, but at the end of the day, politicians are elected by the majority of people, and so even if things don't look like it's moving in the direction of the majority, at some point it will. So we'll see what happens in the courts. Next question we have is coming in from Keith. In Vancouver, it's rare that rental income on a single family investment property covers the carrying costs, let alone the profit. Is it worth covering those extra costs for the next 5 years until the market hopefully improves for the gains that may come from the sale?
think I'll take that one on, Brandon. I think the carrying costs, obviously, when you got Strata and you got, the ones that I've dealt with, like you want to be as cash neutral as possible on a rental, right? So if you're working with a proper realtor like Ryan and myself together jointly, we find pockets where we look at your down payment, we look at how much effect that'll have on your new mortgage, and we want to find a cash kind of neutral sort of situation with your rental purchase. Or if you're moving or upgrading from a home, like you're living in a condo now, you want to move to a townhouse, kind of like what I did back in the day. Um, that's the same sort of situation where we look at like, okay, we're taking out the equity. When we take out that equity, what does that look like for the rental that we're leaving behind now? Because our principal residence moving over there. So, it's all strategy. It's about having a team beside you that's looking out for best interests. And when you have the proper realtor and you have the proper broker, we're looking at all avenues, right? To make sure that's cash neutral situation. Back in the day for me, it was cash flow situation because of where rates were, but that's kind of like, we're in more of a normalized rate situation, which I think is healthy for us and for everybody, where we were in kind of make believe land before, right? So
Yeah, government policy was a little bit crazy for a minute there, but this is just a wake-up call that rates can't always be super low, and government policy can't always just support the real estate market. Although we are starting to see some new policies be released, particularly in Ontario, that are kind of giving a gift to the real estate market. So I don't think Canada is going to ignore its real estate market going forward. It's just I'd say it's a newish government recalibrating, and we'll see what support for real estate looks like from here. Uh, and I will say, as a financial planner, even if your rental income doesn't cover all your costs, it may still be worth holding a property. In particular, don't forget that the principal payment you're making towards that is almost like forced savings. That's not actually really a cost in a sense, because all of your other costs, strata, interest,
correct.
that's all tax deductible
Is the
against the
actual
income you're
interest,
moving
like
from.
it's the interest portion of that mortgage payment is the cost, right? So if the cost is over $200, it actually probably isn't the cost, right? Because you're paying down that mortgage for that principal portion, right?
Mhm.
So that's still your money. Um, and it's more like honestly, if you're in tax purposes, you probably want to be more equilateral with regards to interest, actual costs of your mortgage and revenue you're earning from it, right? The additional cost might be the extra $300 a month that you're putting in for your principal.
Yeah, definitely. Now, Jen's asked, she's heard about many realtors talking about buyers stuck in the past, not being willing to budge on price. I'm not sure if she means sellers here, but when will sellers? I think she means sellers be willing to start adjusting.
Yeah, I can take that one there. Thanks for the question, Jennifer. So yeah, it's going to be a question of who's going to blink first, right? Right now, just because of the amount of inventory in the market, buyers do have a lot of selection. So the reality is that a buyer is going to offer on a property, and if the seller's not willing to entertain that offer or come close, they can go shopping around to another property, right? So the properties that are doing quite well right now are the very unique ones where there's not many options or it's got a very unique attribute. That's the ones where buyers kind of get very tunnel focused and they will come up on price a bit more. In terms of the selling side, yeah, it is tough. People are seeing their BC assessments and then kind of being a bit stuck on that as well. BC assessment, as we know, is from July 2025, so it's not a current market value of the property. But I am seeing sellers adjusting more. The sellers that do need to sell, they try the market for a couple months at the price that they want. And within a couple months, there's, sometimes if they want to sell, they're like, okay, Ryan, like, what do we need to do to sell? And then I'll, give them an updated price. The downside of waiting too long is that in that meantime, the market's edged down a little bit lower. So unfortunately, if we had gone with the original price, maybe we could have gotten an offer sooner. But sometimes, we do try. And honestly, sometimes we do get lucky too with sellers. So, it's kind of a tough one to answer, but yeah, sellers are starting to be a bit more reasonable. And honestly, both sides are starting to realize this market, it's not falling, it's not climbing. Like everyone, I'm starting to see a bit more of that happening, but I think there's still a bit of a gap there. And it's hopefully by the end of this year, next year, people will get kind of on the same page again.
Can I continue on that just a little bit, Brandon?
Yeah, please.
So on the commercial side, we've also seen, we've seen both. We've seen many sellers that are stuck to their price, but we've seen many sellers come off their price. And a great case in point is um, an apartment building that we sold in the downtown core that was listed in 2021, 2022. And they ended up getting an offer kind of in the high teens, low 20 million range. At that time, they didn't want to sell. They felt the land value, underlying land value was worth much more. Um, we ended up getting the listing over some time, and eventually we ended up bringing an offer in kind of the 13 million range, subject free from an investor. And at that time, to be honest, when I presented the offer, I knew the owner very well, quite a stubborn older gentleman. And I thought, okay, he's just gonna chase me out of the room and say, find me a better buyer, and that's fine. Our duty is to present the offer. So I actually, to my surprise, I presented the offer, and his outlook on life had changed, and he was thinking that, I just want to enjoy my life. I managed this building myself. I painted the building with my own two hands, like all these things. And he actually ended up accepting the price. We counted on a few other terms, but sometimes timing is everything. And so what I think in both respects of residential and commercial, to be honest, you don't know unless you try your offer. So if you don't try an offer, you'll never know if they're willing to sell at that price.
Yeah, I think it's the realization of people like if they're selling here and buying here, that it's equilateral, right? So they're going to get a discount on the purchase and they're going to give a discount on their sale, right? The ones that are like forced to leave and I have to move from Vancouver to Toronto because I have to, that's where you're going to see a reduction of price, right? But it's also like, if I was a realtor, I'd be talking to my client playing like, yeah, like we're lowering the price here to sell it, but you're buying another place, so you're gonna get that lower price as well, right? So it's all equilateral on that front. At the end of the day, like the lower prices, I would guess in the condo, townhouse, first time home buyer market is where people are like they're like, oh sweet, I can finally buy a house at a discount because they were renting before, right? So.
Yeah, and worst case, go to the estate sales. There's a lot more estate sales these days too. So if they're not going to sell,
Oh god, yeah, like the yeah, estate sales, foreclosures. God, the amount of people that have helped out of foreclosures in the last couple of years has been through the roof. So,
yeah, like get
um,
your real estate professionals to work for you, right? Like they'll help find you these opportunities once you build a relationship, and you just got to find the right people who truly care and have a pulse on the market. We've got a good question here coming in from an anonymous attendee. And I know we're over time, so for those of you that have to go, I do appreciate you coming in, and feel free to follow us on social media if you want to see some more content that's sort of real estate or financial planning focused. But for those that do want to stick around, we'll continue running through these questions. So, for those who are not yet in the market, how do you weigh the risk of taking on a large sum of debt, especially during high unemployment rates, versus investing in other strategies? They go further to say, I found that long-term financial strategy in Greater Vancouver is almost one-to-one as investing and versus renting. So, my thought as a financial advisor, financial planner is as long as you're leveraging and using leverage to your advantage, that's the big advantage. But also it's a choice of like your life quality. Like where do you want to live? Do you want to have control over your home? Do you want to have control over your business? Uh, you can rent forever. If you've got a very low cost of rent and you're buying rental properties or you're leveraging into the market, that can work. Everyone's situation is different, but I don't know if you gents want to share anything else.
yeah, no, I think just like you're never gonna like it's all luck in this industry some ways, and I kind of screwed when we bought my current place, but whatever, I made it work. But if you're going into the mindset that I have to buy at the bare bottom, like that's never gonna happen unless it's luck, right? Um, and and you can't go through real estate as it's a short-term investment. Real estate in Vancouver, we live in a bubble. There's mountains to the north, there's ocean to the west, there's mountains to the east, and there's the US to the south. So we are literally in a bubble in the lower mainland. So once consumer confidence goes up, you're going to see people jump in. So I say right now, when we've seen a discount over the last 2 years, I don't see this lasting that much longer. I really don't. If this war ends, consumer confidence will click and you'll start to see news articles. And then all of a sudden, momentum happens and boom, crash again. Everybody jumps to the pool at the same time. So I would say if you're an investor, if you're a first-time home buyer, now is the time to buy, because you're gonna get the best discount. If you're selling and buying, it's all equilateral, right? So, or if you want to refinance and buy, this is a great opportunity to leverage equity in your
Okay. Thanks, Kevin. Now, Mark's asked, when it comes to investment properties, do you still want to aim for that 20% down payment, as you would with, say, a primary residence, or is aiming for lower, a better choice in order to maximize your investment potential?
Yeah, like it's funny because I made actually one of my best like investment opportunities when I bought and I upgraded from a detached home to another detached home, and I only put 5% down on my new purchase because I was allowed to, right? And all that insurance cost that I paid, it paid for itself within like 6 months. Like the increase in that value of that home, it caught up right away. So when you're going from a home that you're living in moving to the next home, you have a few more options. You can go under 20%, so you can pull out a little bit of equity from the what's going to be a rental and put it towards the new home. But I think we're almost at the edge where you're going to see like what I did back in the day, and that insurance cost on the 10% down payment eat itself up once this rebounds, right? So I think we're on the edge of that. And I would say when I say edge, I'm like 10 months edge, like, you know, somewhere along the way, this war is going to end. Things are going to normalize. Trump's going to be out. Like, I think our real estate, honestly, has been so driven by the nonsense of Trump. Like, and it's unfortunate. Um, and everybody sees it, everybody knows it, and we're all just sick of it and just want it to be over.
Mm. Yeah, I'll just add a little bit here as well. I mean, if we want to be play it safe, I think as generally it's probably more equity, higher equity positions probably just lets you ride it out a bit longer. Someone mentioned earlier, 5 years before things get better. Like, I don't think it'll be 5 years before things start trending in the right direction. We look at immigration, probably in 28, we'll need to reopen. We don't have enough working age people in Canada to sustain the elderly people getting older and the tax revenue from that. So the government is going to be in position to have to reopen immigration. When that happens, the loophole with having a good rental may or may not that might not work in 3, 4 years anymore because you're more exposed to potentially landlords evicting you, coming back to take back the property for personal usage. So I know it depends. Answer isn't great, but like having something with a probably a bigger cushion is not a bad idea right now. But we do think the recovery of things trending in the right direction will be next few years. And by the time we get back to peak, like we're about that 4 year mark. If we look at it as a symmetrical, in the last two downturns and ups, we're all symmetrical down and up. Could be looking at 4 more years to get back up to peak 22 pricing, but that doesn't mean the direction is going to change. The direction is more important than the absolute number, right? So again, once immigration reopens, rental rates start coming back up. It's going to make more and more sense. But I would have like a 2 to 3 year window before we start trending that way, and then 5 years, 3, 4 year, 5 years before we're back to peak pricing again.
Excellent. Well, I know we're a bit over time, so I think we'll just have some final comments here as we wrap. But I do want to say that the real estate market moves much more slowly than the stock market. So the stock market, we see daily jumps, we see tons of news. Real estate is much more slow, much more affected by government policy, by immigration, as Ryan's mentioned. So for that reason, you should be taking your time to do your homework, do your research before you make these big decisions, and you should have some good people in your corner. So yeah, Will, Kevin, Brian, thank you, gentlemen, so much for coming on and sharing your expertise today. Really appreciate it. If anyone is looking to get more great intel, I'd say follow these guys on LinkedIn or on Instagram. They post some fantastic content. And yeah, any final words before we say farewell?
Thanks for joining, everybody. Appreciate the time here.
Yes, thank you everyone, and feel free to reach out to any of us individually if you got a little nervous asking questions in front of other people. So happy to answer them.
100%. And I just say, like, always surround yourself by good people. Good things will happen. And I can tell you, each four of us as gentlemen, like, we are good people. We do good things, and we help our clients. And that's what drives me every single day. Is just helping people be better and do better in life. So, thank you, everybody.
Beautiful. All right, guys. Have a great Easter long weekend. Thank you for spending your Thursday evening with us, and we'll see you soon.